now hand the conference over to Mr. Shogun Jain from SGA. Thank you, and over to you, sir.
Thanks, Rio. Good afternoon, everyone, and thank you for joining us on the Mahindra Logistics Q3FY21 earnings conference call. We have with us Mr. Ram Praveen Swaminathan, MD and CEO, and Mr. Yogesh Patel, CFO of the company. I hope everyone got an opportunity to go through our financial results and investor presentation uploaded on company's website and stock exchanges. We will begin the call with opening remarks from the management, following which we will have the forum open for questions and answers. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you yesterday. I would now like to invite Ram, MD and CEO of Mahindra Logistics Limited, to give his opening remarks. Over to you, sir.
Thank you, Shogun. Good afternoon, everyone. I trust all of you and your dear ones are well and keeping safe in these challenging times. As Shogun already stated, I hope all of you have had a chance to look at our results and the presentation which has been uploaded on the stock exchanges and the company's website. As always, in my opening comments, I will share some updates about the industry, how our end markets and segments are performing, and we'll also touch upon operational and financial performance for the quarter just passed and 9 months of FY21. Overall, the quarter under review saw a continued acceleration of our strategy, focused on delivering customized, integrated solutions to enterprise customers in supply chain and mobility. During the quarter, we reported our highest quarterly revenue levels with continuing growth in EBITDA and PAT. Let me talk a little bit about our two segments, supply chain and mobility, beginning with the supply chain segment. In the supply chain segment, the broad recovery we saw in Q2 has continued to accelerate itself in Q3. In addition to structural improvements, growth was driven by consumption returning to pandemic levels, accompanied by the uptick in the festive season. While the growth has been witnessed across all our end markets, let me touch on each of them individually, beginning with the auto, farm, and engineering business. The Indian automobile sector has been trying to cope with the slowdown even before the pandemic, which was obviously aggravated by the outbreak of COVID-19. And the sector has now gradually been making a recovery. As companies pick up pace despite these challenges, we saw a strong turnaround in the auto sector in the third quarter. Rural and that flowed through our demand as well. Rural and semi-urban demand continues to remain robust on the back of higher kharif output, better cash flows, and strong rabi sowing, translating into strong demand for tractors over the last few months across our OEMs, including M&M. During the quarter, we saw a continued uptick in volumes driven by these factors and accelerated in some measure by the festive season. Our auto OEMs have shown strong improvements, and the industry across has done well, especially in Tier 2 and Tier 3 cities, translating to positive volume growth for our customers and in turn for us as well across all our accounts. Our auto volumes were impacted to some extent unfavorably by supply chain challenges in some of our key OEMs, but overall continues to show a strong underlying trend. Farm demand remained extremely strong in the quarter, with strong growth in all our OEMs in that sector. And obviously, we saw strong offtake in the southern part of India in preparation for Pongal and the festive season there. In the manufacturing engineering side, outside of auto and farm, our volume growth was visible. Growth was driven both by expansion in existing accounts as well as increasing volume from new accounts. On the flip side, one of our larger auto OEMs in Maharashtra announced a shutdown of their operations on the back of a sale of their manufacturing operations in that area. That shutdown is effective December 31st. This will have some impact going forward, but we estimate that it will be offset with new accounts which we have commenced business with. Moving on to e-commerce. E-commerce continues to see really strong growth as all companies start accelerating their shift towards digital channels. Marketplaces have also increased their focus to adding more suppliers to their systems and platforms. In Q2, we saw an underlying improvement in addition to pent-up demand on the back of the pandemic, as e-commerce came to the fore as the preferred mode of shopping for many. As we look at Q3, e-commerce platforms continue to gain popularity as customers see the convenience and safety of having their purchases delivered at their doorstep. In this quarter, we saw strong demand, especially given the peak driving volume in October and November. We did see some unfavorable impact because of supply chain challenges from East Asia, which had some impact on durables and electronic products, where we have a strong presence. For our business, we saw three positive trends. Firstly, peak-driven volume with higher volumes for our processing and fulfillment solutions, an increase in transportation volume. Secondly, we saw a strong focus from our customer partners to expand coverage. And this was something we were able to service with our Flex and Pop-Up solutions, which we talked about last quarter as well. Lastly, we have been able to develop and expand our presence in groceries and essential products, and launched some fulfillment centers for those segments in the last quarter, and we'll do so this quarter as well. As we look into the future, we expect the demand from e-commerce will continue to grow. We have strong customer partnerships, and fundamentally post-COVID, customers will continue to adopt the convenience offered by marketplaces and digital channels. We also expect to see a strong growth in electronics and heavy and bulky products in the coming quarters. Moving on to the consumer space, or what we call consumer, pharma, and telecom. We continue to see positive traction in durables, FMCG, pharma, and apparel. While volumes clearly have started exceeding to pre-pandemic levels, the festive season has also been a catalyst for some segments such as apparel, which have shown strong growth for us. Post-pandemic, most companies in FMCG, durables, apparel, pharma have had to review their distribution fulfillment models with increasing attention to omni-channel systems and digital channels. Consequently, companies and our customers have been redesigning their supply chains with higher focus on digitization, multimodal fulfillment, and B2C models. And all of those have translated into good uptake for us as well. Telecom services have, and the telecom segment for us has remained sluggish despite the growth in the sector. Most of our customers have been focusing on working on the 5G upgrades, and therefore there's been a sluggish volume trend in the short term. But we expect that will be followed by a spurt in demand that in the near future as companies start accelerating that move towards 5G. As all of you are aware, India has launched what is arguably the world's largest COVID-19 vaccination program. COVID vaccine distribution represents several opportunities for logistics companies such as ourselves around domestic warehousing, transportation, cross-border logistics, and last-mile delivery. The initial phases are obviously closely monitored by the government, with distribution and last-mile delivery largely through government-managed systems. However, special handling skills, the need to maintain product integrity, and monitoring the movement of the vaccines closely are some requirements which enables 3PL companies and logistics players to maintain and provide a significant value proposition. We have not seen a significant flow-through or a material flow-through of volume from COVID-19 in Q3, but we remain focused on building long-term cross-border solutions for pharma companies who are manufacturing vaccines and also supporting them on primary storage and distribution. And we expect to see some flow-through of that starting the next financial year. And lastly, let me talk a little bit about commodities and bulk. Our strategy for this segment, and we have covered this earlier, remains focused on selective customer partnerships, where we can offer strong customer value through inbound and distribution, leveraging network optimization. And we continue to remain focused on that strategy, while also trying to ensure profitable growth and positive cash yields from the segment. So overall, I think it's been a strong quarter for us from an end market perspective, and it's a trend line we hope to continue to accelerate as we look forward. At the supply end, or the back end of the supply chain business, we have seen we have obviously seen some moving parts there. The freight forwarding business continues to see some level of tightening. Right, globally, freight forwarding rates have seen a strong surge, and this has impacted rates on East Asian and European lanes, with more blank sailings by several carriers. This trend is expected to continue in the near future. I think we've done a strong job in using technology and analytics to be able to forecast our business and manage the supply side well there, but requires continuous engagement there. In the domestic market, line haul truck availability has been impacted by fuel price hikes, a seasonal demand pickup, and a liquidity crunch which many transporters are facing. The farmer strike has had some impact to our operations in North India, especially with movement of vehicles through Punjab, Haryana, and Uttarakhand. These trends have put pressure on our costs, but we have been able to maintain our contracted service levels with customers and have cost reduction programs which have largely mitigated the impact of this. Overall, across the segment, we have seen an uptick in demand for integrated customized solutions. During the quarter, we were able to score some key wins. For one of India's largest consumer durable companies, we will be starting providing end-to-end supply chain solutions, which manages the entire supply chain from vendor to distributor. We also are expanding our distribution solution in North India for a large pharma company. We went live during the quarter with a leading defense manufacturer, providing them comprehensive warehouse management services. And on the e-commerce side, for one of India's largest marketplaces, we have commissioned a large grocery fulfillment center in Eastern India. We're also partnering with a large food distribution marketplace with solutions for their upcoming grocery initiatives. In the auto outbound business, we have one business with a large leading European OEM as their exclusive distributor for their passenger cars and SUVs. Most of these accounts predictably have not seen an impact in our revenues in the quarter just passed. And as typical with our programs and new accounts, there is a lead time before they start hitting our financials, which ranges between 3 to 4 months based on the nature of the solution in the program. But we continue to see that strong uptick in terms of order intake, built around our strategy around customized integrated solutions, with a strong bias towards fulfillment logistics. So with that, let me move on to the enterprise mobility segment. Our enterprise mobility business, as all of you have seen from the results, remains severely impacted by the pandemic. Most companies are continuing to follow work from home policies, and this has impacted the number of commuters and our trip levels. While those headwinds continue to be there, we have made an aggressive effort to add customer accounts from manufacturing e-commerce companies, and this has helped offset the sharp decline from IT-enabled services and banking, which is our traditional markets for mobility. It will be several quarters, we believe, before we see a full recovery. But we believe the long-term dynamics of shared mobility for both work to home and business travel demand remains positive. We have been focused and we continue to be focused on driving cost optimization and service expansion, and we'll sustain that strategy while a recovery curve emerges. Let me now talk about our financial performance for the quarter ended 31 December. Revenues for Q3 increased to 1,047 crores compared to rupees 908 crores for the same period last year, up 15%. Revenues were sequentially or on a quarter-on-quarter basis up by 26%. Revenue from our supply chain business contributed 96% of our total revenues, and enterprise mobility contributed around 4% in Q3 FY21. Our gross margin for Q3 stood at 9.9%, which compares to 10.3% for the same period last year, a decline of 46 basis points. The year-on-year GM decline was impacted by two primary factors. Firstly, the volatility in transport supply due to fuel pricing availability resulted an impact in margins on transport, and that had an impact on our overall mix. Secondly, new projects which we have launched during the quarter also have the typical margin ramp up and had slower margins in the startup phase. We expect our new project margins to stabilize in the coming quarters, as we had seen for projects which got launched last quarter as well. EBITDA for the quarter stood at rupees 55 crores compared to 44 crores in Q3 FY20 and 46 crores in sequential quarter of Q2 FY21, an increase of 20% sequentially. Adjusted EBITDA for ESOP and RSU charge stood at 57 crores in Q3 FY21. Profit before tax is up by 17% from rupees 21 crores to in last year to rupees 25 crores in Q3 FY21. PAT was up by 24% to rupees 18 crores, and PAT was up by 17% to rupees 18 crores, and PAT margins for the quarter stood at 1.7%. PAT adjusted for the RSU charge was up by 8% from 18.37 crores to 19.9 crores. Proportion of revenue from the Mahindra Group comprised 49% of our total revenues in Q3 FY21 compared to 48% in Q3 FY20. Let me talk a little bit about the segmental breakup of revenues as well. Revenues from supply chain obviously increased from 817 crores to 1,009.8 crores in the quarter just passed. Enterprise mobility segment revenues stood at 36.9 crores for Q3 FY21, down by approximately 60% from a comparable quarter last year. The supply chain side revenue has obviously seen a continuing impact of our strategy execution as well as the overall recovery and the uptick in the festive season demand. Our revenue from the Mahindra Group supply chain businesses increased from rupees 424 crores to rupees 508 crores, a strong improving performance driven by both the continued acceleration of the farm business and the recovery in the auto business. Our non-M&M SCM business grew from 392 crores to rupees 501 crores in Q3 FY21. This was obviously driven by our continued growth in e-commerce, freight forwarding, consumer and pharma verticals. Growth in e-commerce and consumer segments continue to see increases due to demand and because of deeper penetration with existing customers and our continued growth in our integrated services portfolios. Our warehousing and value-added services for non-M&M SCM businesses, which is a core strategic focus, has grown from 121.9 crores in Q3 last year to 164 crores in Q3 this year, registering a growth of 34%. Share of warehousing and value-added services in the non-M&M SCM business has reached 33% in Q3 FY21. We continue to see obviously strong growth across all parts of that segment, including auto, e-commerce, consumer and pharma and freight forwarding. Our focus on maintaining costs and cash flows remains strong. Cash and cash equivalents at the end of December 2020 was rupees 188 crores compared to rupees 113 crores at the beginning of this financial year. Before I open up for comments, let me just wrap up by talking a little bit about our broader strategy execution. As we have done over the last 9 months, the quarter just passed, we remain focused on executing our 4 strategic platforms. Our first platform is our focus on integrated solutions, and we continue to accelerate that growth, as you can see in our numbers, with a strong order intake for integrated distribution, fulfillment and sortation solutions, and network optimization. We continue to expand on our targeted services lines. In addition to our historical strength in line haul and mid-mile transportation, we have seen strong growth in our freight forwarding business, which has continued to grow through this financial year and has actually registered a 90% growth in the quarter just passed. Our express services have grown by over 40% in the year-on-year in the quarter which just completed. And during the quarter, we also launched EDEL, our electric vehicle-based last mile delivery solutions. Initial customer feedback on that has been extremely positive. We also continue to provide our customers multimodal offerings through expanding set of rail-based services, and we've seen a strong growth there as well. Our third strategic platform is operational excellence, and we continue to invest in developing deeper functional capabilities, driving cost reduction, and expanding our warehousing footprint. During the quarter, we have contracted further build-to-suit warehousing infrastructure in northern India and near Mumbai. As you have noticed, we expanded our warehousing footprint by nearly 1 million sq ft during the quarter. And over the next few months, several new sites are likely to be commissioned. Our fourth and last platform is digitization innovation. We have launched several new systems this quarter with upgrades to our transport management system, a new warehouse management system which is focused on fulfillment logistics, a new HR management system, and an integrated site management platform. Through the mobility sector's Catapult Incubator program, we are partnering with 9 companies focused on technology innovation, automation, and transportation, last mile distribution, and warehousing. The quarter past has been a strong and improving quarter, driven by the exceptional efforts of our entire team, focused on delivering results and continue to invest in our partners and communities. We remain pretty optimistic about the future economic environment, continuing recovery, and hope the upcoming budget will be a catalyst for future growth. With this, I open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Dipesh from Equirus. Please go ahead.
Yeah, hi, sir. Thank you for taking my questions and congratulations for good numbers. Sir, if you look at the Mahindra & Mahindra overall volumes for third quarter, it is showing us low single-digit growth, while your growth in Mahindra supply chain business is 20%, which is more like a farm equipment volume growth. So just wanted to understand how to read this, and it will be helpful if you can give a sense of contribution from the farm equipment, passenger vehicle, etc. And has the mix changed dramatically in this quarter?
Yeah, so I would say that if you look at our overall growth, which is roughly around 20%, clearly stronger growth is from the farm sector. Our farm sector volumes grew by over 30% during the quarter. And so obviously that has been a strong catalyst for our overall performance on the M&M side. That's not, bear in mind that volume by itself is not a direct correlation. Since we run miles, it also depends upon the distances covered, the destination, the lanes which we run the vehicles on, and the transportation services on. But broadly, farm definitely was a stronger contributor from a growth perspective. Overall, though, I think our balance remains weighed more towards the auto side. The auto segment for us did grow at double digits as well, driven both by growth on inbound network optimization services we provide them, growth in spare parts, as well as outbound vehicle movement on the auto side. So a combination of those things, I think, did result in kind of a double-digit growth on the auto side as well. From a portfolio perspective, we are still weighed more heavily towards the auto side than the farm side on the M&M business.
Understood. Secondly, sir, just want to understand the increase in the depreciation and the interest cost in the quarter 3 numbers. Your presentation mentions that this is on account of higher volumes on the warehousing services. So can you please explain that, and how should we think about it going forward? Thanks.
Yeah, I think the commentary is right, but I'll probably Yogesh. I'll let Yogesh take that more specifically. Yogesh, you want to just talk some detail on that?
Okay, got left out on mute. If you'll have to repeat that question for me, please.
Yes, just wanted to understand the increase in the depreciation and the interest cost in the quarter 3 numbers. Your presentation says that it is because of the increase in volume, so that I didn't understand. Thanks.
Yeah, sure. So, if you recall, post adoption of Ind AS 116, which came up last financial year, the lease charges which we pay for our warehouses now gets accounted under depreciation and amortization line combined with interest line. So these, earlier this lease charges were directly taken as rental cost or direct cost itself. So that piece is, in our share of business also, have you noticed over the years that we have had, quite a bit of shift in revenue mix or business mix where we have higher component or growth in warehousing services itself. So that piece, cost related to that piece does get accounted under these two line items, and you see the growth there hence as well.
But sir, does the lease charge increase with the volumes?
The volume from a space perspective, not from a unit handle perspective.
So this is the base going forward, right? This is how it should be going forward also.
Yes.
Okay.
I think, Divesh, as just to add to what Yogesh said, as our warehousing-based solutions businesses grows, you will just see the increasing amount of square feet of warehousing, and therefore you will see that having representation on these two lines of our business.
Okay, I was wondering, that's why, because the warehousing space is like kind of decreased to 17.2 from 17.3 last quarter, but this depreciation number has increased. So that's why I was wondering what is driving this. Is it because of flexi warehousing solution? Is that also coming into play?
Because last quarter's number was around 16.4. It wasn't 17.2 if I recall, unless and until you had added that launch of BTS, what we had mentioned as well. So those BTS, what we had launched was in the quarter towards the end, so the full quarter impact of that came in.
Okay, got it, sir. Thank you. I'll come back in the queue. Thanks.
Thank you. The next question is from the line of Ashwini Agarwal from Ashmore Investment Management. Please go ahead.
Hi, good afternoon, team. Congratulations on a good set of numbers. Couple of things. In your opening comments, you referred to a large auto customer who's shutting operations effective 31st December. So obviously this impact flows into Q4. Could you give us a sense of how large this might be relative to overall revenues?
So Ashwini, hi, how are you? And I hope you're doing well. So we have shut down. So the operations impact on our business, we provide them stores and line feed services in that plant near Pune. And the overall financial impact of it is, in the broad scheme of things, is very marginal. It's one of our smaller contracts, and therefore it's already offset by new business which we have won, Ashwini.
Oh, okay, wonderful. Okay, good to hear that. And second question is that on your people transportation business, it's already reduced to a fairly small number, and I'm guessing that this will take time to get back up to normal levels over the next 3 to 4 quarters, as more and more companies seem to be talking about flexible attendance at work, especially in the IT and ITES space. So as your core warehousing and logistics management and various other businesses increase, would it make sense to continue with this business line, which has been very volatile and has been a source of pain for a couple of years now?
Yeah, so it's a good question, and I think I mentioned last quarter that we will at the right time do a broader strategic assessment of the business. At this stage, what our hypothesis is that this is a 12 to 15 months, 3 to 4 quarter window. Right? Once the vaccine settles down, in order of priority, I think people will obviously choose personal transportation and shared mobility over public transportation. Right? We also believe that companies and employees of companies, as they come back to work, will also have a higher accent on safety and security. So while the next 3-4 quarters will be challenging for the mobility space, there are 2 positive tailwinds. One, I think, is that we are the market leader in that space. So we expect that when the recovery comes, we will probably gain strongly from that. The second thing, obviously, is that the industry will see some amount of restructuring within the competitive landscape. As potentially fewer players emerge out of that situation. And therefore, we are optimistic that over the next 3 quarters, if we continue with our strategy, actually, we will still have a pretty strong and robust business. Now, And that's kind of our hypothesis around that. We continue to look at saying how can we expand the business. So I talked a little bit in my opening comments about how we are focused on e-commerce and manufacturing, and we're trying to diversify our segment base. Last quarter I talked to you about the fact that we are launching some on-call. We launched on-call services and try to do some service line diversification. This quarter we really invested in doing market diversification. So we are making those tactical moves to supplement this kind of the strategy of slugging it out with cost optimization and kind of these initiatives and waiting for the recovery to come out. Now, from an overall scheme of things, obviously we are now a 96% supply chain logistics company, and we're only 4% on mobility. So one has to strategically look at saying what's the best way to structurally balance these markets and this segment, right? And that's something which we will strategically look at the leadership of the company in the coming few months.
Okay. And last question I wanted to ask was on your express side and on the B2C side. My understanding was that historically these were kind of large packages, especially on the B2C side, last mile delivery, where you would do washing machines and large format televisions, etc. I also heard you talk about, doing a new contract where you're doing some fresh food supplies and things. These are all B2B, right? B2C continues to be limited to these large format deliveries.
Yeah, so we do. So I think, as you said earlier, we largely do our express business is a B2B express business, and we provide that as part of an integrated portfolio. In our last mile delivery business has historically been dominated by large package, right? Heavy, bulky stuff. We do some amount of small package, but it's not a very large part of our revenue base. And that mix continues, right? With EDEL, we are obviously seeing and expecting to see some expansion in that small package volumes, because we are in many use cases now able to demonstrate how an EV-based delivery system is both sustainable and cost-effective to our customers, right? And we are seeing some early traction on that. The coming quarters will probably talk to the quality of that strategy's rollout. But that will be one beachhead for some increased growth in B2C. But otherwise, our strategic focus remains on B2B. And the reference I had in the growth on the food delivery company was really around working with them on the grocery side of their business, not on the local food delivery side of their business.
Okay, perfect. Thank you, sir. All the best, and I'll come back for more questions.
Thank you. Before we take the next question, we'd like to request participants that in order that the management is able to address questions from all participants in the conference, to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Hi Ram, hi Yogesh. Congratulations on a good set of numbers here. So first question on the warehousing bit. Now there is a good revival that we have seen across the segment here, not only non-M&M but overall as well. So your thoughts there. One, as Yogesh earlier mentioned, ramp up of the last big warehouse that has also been contributor here. But is this also flex solution that we had started in the last quarter which is contributing? Where I'm coming from is whether this will be a base case, let's say warehousing revenue for us, given this business is more sticky, and here on probably there should be growth, or there could be some one-off.
Yes, yeah. So without getting into the weed, right? What I would say, Ankur, is that we expect to continue to see growth there, right? And obviously we are. I talked about the fact that we are contracting out obviously more warehousing space in multiple markets, and we have a strategy to build a nationwide spine in our warehousing footprint. So that's something which we expect to continue to see growth on. And as far as flex solutions are concerned, we believe that providing customers resilient and flexible supply chain solutions is critical and is the new normal. Right? So as our customers try to expand reach, try to densify their network, but also deal with volatility in demand, there is a need to bring on and turn down capacity at short intervals. And therefore, we expect that flex solutions as a model as an offering for us, as a solution and offering for us, will continue to be one of our stable offerings going forward. And it's increasingly now, Ankur, moving away from just being a festive or a peak thing to really being a network expansion strategy as well. So somebody goes into, let's say, West Bihar and says that we want to actually drive penetration in that market. And can we actually turn on a short-term fulfillment or a forward FC of some kind to kind of provide short-term penetration? And once we see volume, visibility, and traction, you then put a larger and more permanent network node there. So I think we will continue to see this as a way of doing network expansion and also as a way of managing peaks and kind of volume variability.
Sure. So, Ram, just a clarification. Now, in your earlier, opening remarks, you did mention scale up in the integrated solution offering. Where we'll be offering transportation as well as warehouse and maybe even freight forwarding here. Is that also a contributor to the growth here, or that is still a small portion in the overall scheme?
Yes, I think our integrated solutions. It's an articulated vision which we developed as a business last year, saying that we want to actually put a significant amount of energy around driving that to our customers. We believe that all our customers have unique and individual supply chains which flow from their individual strategies as businesses. And therefore, they do need customization. At the same time, as there's increased variability and volatility, there is a need for and value of integrating different elements of their supply chain, warehousing, distribution, inbound transportation, even within distribution between part truckload, full truckload. And what we are uniquely positioned to provide that, Ankur. So a lot of our newer business wins are actually accelerating around integrated solutions. So in my opening comments, for example, I talked about several of those wins. For example, grocery, we are doing FC plus we are doing delivery. Right, the end-to-end solutions for a consumer durables company. That's everything. That includes the entire warehousing, sortation, processing, pan-India network of that infrastructure combined with primary and inbound distribution plus secondary distribution to the retailers and dealers. So more and more, I think we are seeing that play out with our customers. I don't have the specific numbers, Ankur, and I can take that or respond to it offline. But you will, but it is an increasing share of our order intake.
Sure. No worries. And just one last question. From a revenue ramp-up perspective, and I'm referring both to you as well as the older customers, will it be fair to say that all the client additions that we would have done in FY20 would have started contributing to our revenues, or there is still some bit of that is pending and they could be scaled up there?
So I think it depends a bit on the service line, Ankur. So on express, line haul transportation, and freight forwarding, I think the translation of win to order. So what we measure, we have a metric on order to revenue ratios in terms of latency. Those are pretty immediate. So those are probably 30 to 60 days based on the nature of the service. But anything which is an integrated solution or warehousing base takes a longer period of time. So obviously, most of our order intake in Q1 and Q2 is reflecting in our numbers. And you are seeing some of that show up in that growth which you see there, in addition to the seasonal uptick, which flows to our existing volumes, existing assets, or existing footprint. A lot of the Q3 order intake is yet to flow in.
Okay, thanks. Great. Thanks a lot and all the best.
Thank you. The next question is from the line of Manish Goyal from Enam. Please go ahead.
Yeah, thank you so much, and congratulations on very good set of numbers, sir. Sir, just clarifying on ESOP charge in current quarter in Q3 FY21, is there any ESOP charge? Just want to clarify.
Yogesh?
Yeah, there is.
Yogesh, can you respond to that?
Yes, very much. Manish, there is. I mean, our scheme, what shareholders had approved is for 4 years. So this is the third year underway, and there is a charge for that.
How much is that for Q3 and for 9 months?
Would be around, for 9 months, would be around 7 crores.
And for this quarter?
2.5.
Okay. And Ram, just on the, and sorry Yogesh, just to harp again on depreciation number. See, as I'm looking at the YOY number on space addition, it is just only 4%, whereas our depreciation increase is quite significant increase. Even on, if we see quarter on quarter basis also, it has gone up. So I believe even last year we had this India's 116 adoption already done. So I'm just wondering why such a, like, this quarter YOY depreciation is up 29%, whereas warehouse addition is only 4%. So where is the disconnect?
No, Manish. So on depreciation, the earlier question probably I was explaining from a sequential number perspective. But if you look at it year-on-year perspective, the depreciation has, what a regular depreciation will be there of the fixed assets, what we would have invested in as well, right? So that we, in the warehousing value-added services business is the only places where we have invested capital. And suppose, if I were to look at my last year's capex spend, per se, which was a little over 60 crores. So a depreciation of that which not have existed in last year would have come and added in this year as well. So from that perspective, if you break this up, it will have components of both of them together. Second thing, Manish, also I will add here for you here is the way those things come up is the older warehouse space where you have a declining scale on which the amount gets
Sure.
So newer ones will get additional higher charge as well.
Okay. And what will be the capex for current year? So I believe depreciation increase is also a function of our investments into technology related investments. So just on the current year, what will be our capex?
In 9 months cumulative, it's been 40 crores, 39.5 crores.
Okay. And just want to squeeze one more question, just to get a sense on the mix of our non-auto business. I believe earlier it was like e-commerce and consumer was roughly 50%, and so that number seems to be remaining constant at 50% despite our revenues growing here. So just would appreciate if you can give us a more clarity as to the breakup in our non-auto business, and now with, I believe, freight forwarding also growing. So if you can throw some more light into the breakup, that is one. And second related question in terms of our top 20 customers, we used to share a number earlier in terms of what used to be the contribution. So maybe if you can give us some perspective as to how is the top 20 customers contributing, or the new client addition, what even Ankur was referring to. So how is it shaping, like new client addition on say 1 year or 2 year rolling basis, how it's been growing in contribution? Some sense on customers. Thank you.
So I think both. I think our e-commerce, our fulfillment logistics elements, e-commerce, consumer, pharma, telecom, and our freight forwarding piece together, now money should be close to around 75% of our overall revenue, right, on the non-M&M side, right? So those are continuously strong acceleration in that side. So there is an acceleration happening there, and I think there is an overall lift happening as well. So the tide is increasing across the board, and when the tide is growing, the level of the tide is increasing in all segments. Obviously, the percentage doesn't veer across dramatically. One area where we have obviously seen is the commodity segment is declining as a percentage of our overall non-M&M business, which reflects our broad strategy, which I've talked about. So that's one. In terms of our top 20 accounts right now are a little bit less than 60% of our revenues. So obviously, that reflects both the account additions we have done. We have obviously added several accounts which are all contributing to our business line. But it's not changed dramatically because our larger accounts, some of our end markets are pretty concentrated in terms of industry composition. And we continue to expand within our existing accounts as well. So the top 20 accounts today are a little bit less than 60%, right, Manish? But overall, which reflects both expansion in existing business, but also the addition of new accounts.
Sure. Fine, I'll come back for more questions in the queue. Thank you.
Thank you. The next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Hello. Yeah. Good morning, everyone. Congrats for great set of results. My first question is, sir, can you explain this last mile delivery venture a bit more in detail? So is this last mile, we understand that were we not in last mile delivery earlier and now we are looking to expand with this EVs, and how is this, we are sort of stressing more on that EVs are making this business more remunerative. So would that not be remunerative had we been using diesel vehicles? So I want this clarification on last mile delivery segment.
So do you have any other question, Prateek? Then I can
Yeah. Second question is on the remarkable growth which we saw in Mahindra SCM. So is this October was significantly strong because of that e-commerce festive sales, or the growth has remained sort of very similar in all the 3 months?
So I'll answer the second question first. Yeah, so I would say our revenues were definitely reasonably flat across the 3 months. Obviously, we did see the Diwali month between Dussehra and Diwali itself actually seen a higher blip than we would see. But our weekly revenues, if I measured on a weekly basis, they were generally we didn't see like a 60 for 2020 or anything like that. We saw a very more flatter trend, with obviously a peak in the weeks where Diwali and Dussehra themselves fell in. On the non-M&M side of our business, obviously on the farm side of the business, both in M&M and non-M&M, that follows that had a Diwali peak, but also had the pre-Pongal purchasing on the farm sector, which typically happens every year, and therefore had that pattern play out. In terms of EDEL, so I think our last mile delivery business, and I think Ashwini asked this question earlier, in last mile delivery, we have historically always been focused on the on the B2C side. We have a B2B and a B2C last mile delivery business. The B2B side is taken care by our express business. On the B2C side, we have largely been, Prateek, a company which we have been focused only on larger appliances, durables, electronics, and so on, where we have had a strong value proposition, where we do both the delivery stations and the delivery itself, right? The physical last mile transportation, delivery to your house or my home. We have been doing small package, right, or mid-package last mile delivery as well, but it's been a smaller constituent of our business. Over the last year, what we found is many more of our customers have been trying to figure out how to make that last mile more sustainable and more carbon neutral. Obviously, as that business grows at 25-30% a year, for us, it just draws down from the growth our customers have as well. So it's as sustainability becomes a bigger agenda, many more of our customers have been saying, listen, can you provide us a solution around that? And the challenge has been having the right quality of assets, but also having services which de-risk customers and provide them the flexibility to operate them. Right? Because you have to optimize the network and optimize the delivery routes, right? And not just having a vehicle itself is not enough. So we've seen that as a strong opportunity, where we've done a bunch of work, both in terms of the product specification. This is a 3-wheeler with a 500 to 600 kilo payload, with a larger cubic box, and therefore allows you to manage a larger number of packages. Keeping a three-wheeler allows us to have a very small vehicle footprint and allows a lot of flexibility to move in and out of delivery stations, in and out of apartment complexes, and so on. So the platform itself provides us the way we expect provides us a degree of agility, and then of course we provide this as a service, right, which is variable or package based. Or day-based or trip-based, rather than just giving like a monthly rental kind of model. So that provides customers a lot of flexibility, and this is a lot more of B2C delivery. So this is not electrical appliances and so on. This is a lot of small package delivery, and therefore, based on the growth of this business, the share of our B2C last mile delivery will see growth. But the value proposition to our customers, which are marketplaces or other companies in FMCG, pharma, etc., who are doing small pack delivery to retailers or to end homes, is really around providing them sustainable, variable service, providing them a lot of the contracting flexibility and the network flexibility they have today with ICE vehicles, but with the sustainability drivers which electric provides them at competitive or comparable prices.
So our business partners will buy these vehicles which they were not buying earlier, and we continue to operate the way we are operating.
Yes, so we are buying some amount of the vehicles in the initial phase ourselves, but over a period of time, it will be a partner-driven model like the rest of our business.
Thanks. I'll get back to the queue.
Thank you, Pratik.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal Asset Management. Please go ahead.
Hi, good afternoon, everyone. Wishing you a happy new year and hope everyone is safe. My first question is, you laid out the strategic vision of FY26 to be a 10,000 crore revenue company. In that, would it be fair to say that your aim would be 40% warehouse, 50% supply chain?
Yeah. So, can you just repeat the question? I couldn't hear it clearly.
No, so the FY26 strategic vision of 10,000 crore revenue. So, what would be the mix of warehousing and SCM then?
Yeah, so I think the way we see it is that, first of all, we see all of this as supply chain management, right? Because we don't really own warehouses. We provide warehousing-based processing and storage solutions to our customers. Now, if you ask a question saying that, so we, as a 3PL, we provide transportations, pure play transport solutions, whether it's freight forwarding, express, line haul, last mile, that electric now, last mile, or we provide warehousing-based, or we provide plain warehousing-based solutions, or we provide integrated solutions. So those are the kind of three elements in our basket broadly. And if you ask me how much would be warehousing-based and integrated solutions, yes. So in our vision of around 10,000 crores, our vision would be to have around 40% of our business come from pure play warehousing and integrated solutions, where we combine warehousing and distribution to provide customers unique end-to-end solutions of different kinds.
So, just following up from that, what would be the non-linearity? Because should we assume that 17 million square feet gives about 800 crore revenue, so 4,000 crore revenue would be 5 times warehousing space, or is there significant non-linearity that kicks in at some point?
Yeah, so there is, I think there are two parts to it. I think, as you know, there are solutions which don't create long-term warehousing space. So I would say there are three parts to it. First of all, just on your question of footprint, obviously there'll be an increase in warehousing footprint per se, right? So that's going to grow, right? And we'll have to grow at a reasonable clip to support this kind of projected long-term volume growth. Now, if we are able to execute to that vision, we'll have to obviously build out the footprint. Now, in addition to a long-term footprint, we also take short-term footprints, which are like our flex solutions, and those don't necessarily count as a long-term footprint, Sushmit, because we add and delete them, as demand comes in and goes out. Right? So they're not long-term sustainable footprints, but they are just more short-term contracts in that sense. Where we see a real revenue, but there will be a non-linearity in the sense that pure warehousing footprint will obviously grow at a slower clip than our overall revenue growth because of our shift towards integrated solutions. So when you do integrated solutions, that combines warehousing and transportation. So for example, when we do a last mile delivery of appliances, when you do delivery of appliances for a marketplace or for a consumer durables company, Sushmit, what we are doing is we are running a warehousing of X square feet where we store and process the equipment. But then we also do transportation of that material into that warehouse and transportation delivery from there. So if you actually take that overall cake of business and say, let's say it's $100, 100 rupees of revenue from that account or that operation, the warehousing part of that will probably only be 35-40%. The rest of it's actually a transport service. And what we do is we blend that all together into a single service line for our customer. But decompose that, and there is a transportation piece and a warehousing piece and an analytics piece, which is all combined together. So footprint, therefore, as that grows, there will be a non-linear growth of revenue, and footprint will actually lag that growth. Right? So therefore, if you ask me, ask us, Mahindra Logistics, if you're looking at if your vision says 5x growth, are you going to increase warehousing 5x? No, there will be a non-linear point where revenue growth will obviously outpace the footprint growth because of the transportation element in the way our integrated solutions work.
But and my last question is, the trial run from the first phase of DSP has started. Have you started thinking about the impact that may be on your operation business? Have any clients come back to you yet, or expect to go on?
I'm sorry, Sushmit. Again, I couldn't hear the question clear. I apologize for this, but
the line is breaking a bit, so I don't know if there is.
Okay, could you just repeat that question?
Yeah, I'm sorry for this. The trial run for DFC first started, right? So have you seen the impact that may have on the transportation revenue in the next year or so? And have you heard from any clients discussing this?
No, trial runs have started. Precipitated volume. So trial runs have obviously started. Precipitated volume movement is yet to transition. But I think to take a step back, I think we've seen that shift towards multimodal happening, and we've addressed this obviously on con calls and meetings earlier as well. I think multimodal works very well in a bunch of use cases. It does not always mean that there's going to be a complete flip over of a switch from road to rail. Right? And we have been supporting our customers with multimodal solutions now for quite some time. So if you look at the auto side, a lot more of our outbound vehicles are now transported through rail. This year, we've actually transported a lot of tractors as well through multimodal rail platforms. So that is something which we are providing that solution or service to our customers already. In fact, the Honorable Mr. Piyush Goyal, some of the tweets which he shared on tractor movement through rail, etc., was all services which we were providing for customers like M&M. So we've already been doing that. And obviously, that will, and some of that movement will move from NMGs or under the AFTO policy towards AFTOs in DFCs. Right? So you will see some of that shift happen out. But I think we are well geared to be able to actually manage that and build opportunities around it.
Thank you. The next question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, sir, good afternoon, and thank you for the opportunity. Firstly is, again, in continuation to this integrated solutions that you were talking about. Just trying to understand, currently for the warehousing business that we are doing, So basically, it means that there is somebody else doing the inbound and outbound, or probably the customer himself is doing the inbound and outbound. And so, just trying to understand why weren't we doing it already, number one, and what would drive us to do that, number two. So, is it something to do with, say, some ERP integration or customer getting confidence in us doing end-to-end? What will exactly drive that, sir?
Yeah, so I would say, Mukesh, great question. I think the dominant change has been the creation of the opportunity to create value, right? So a couple of things I think have happened, right, in our marketplace. Historically, customers, I think in India, from a risk perspective, would prefer to actually balkanize their contracting and pick, let's say, a truck company for doing inbound movement, and company A for inbound, company B for the warehouse. Company C, if they did PTL movement, so they take an express company for PTL, they'll take another company for FTL movement. And then I think the idea largely was that you really want to de-risk yourself and not put all your eggs in one basket, because you saw the downside of it is probably greater than the upside of combining it. There were customers who were doing it, but very few and far between. I think 2-3 things have changed over the last few years. First one, I think externally has been that with GST coming in, people have the opportunity to restructure their distribution infrastructure, but as they build larger warehouse and they start distributing more widely, they actually have to be more accountable for the entire piece, right? And therefore, there's a far greater need to say, how do I sequence all this together effectively? The second thing is that what we have seen as digital keeps growing, and now with COVID happening, is this incredible proliferation in channel. So if you're an apparel company like an Arvind or a Raymond, you are now selling to modern trade like Lifestyle or Shoppers Stop. You are selling to exclusive brand outlets. You are selling online, and you are selling to distributors. Some of them go with FTL, some of them go with part truckload, some of them just go with small package courier, right? And interestingly, with time, these channels are yanking themselves around volume, right? So it's not like it's a predictable pattern anymore. You could have a November where you have one channel being very large volume, a December where another channel is growing, and then you could have a January where all channels are growing in volume. So I think customers have realized that there's an incredible pressure on building an agile and responsive supply chain. And therefore, given these two parameters, the question is, how do I manage this a lot better? And a lot of our customers are obviously talking about saying, listen, the risk of missing delivery and fulfillment is greater, is pretty large as well. So can we integrate all of these in a way where we get better inventory control, greater customer service, stronger resilience within our supply chain, so we can respond to variability a lot harder? Right, so those are actually external changes which are catalysts, if you may, Mukesh, for this opportunity, for the lack of any other word. Now, there are companies and our competitors who have definitely been doing this. There are companies who have been doing it purely on the fulfillment side of e-commerce, and there are players who have been doing it in bits and pieces in different parts. What has changed at our end, obviously, has also been, obviously, as we've done our strategy work, we felt that this was a core area where we could create value. Mahindra Logistics is well positioned because we have a large set of service lines. So we are uniquely positioned because we do FTL, we do a mid-mile, we do PTL, express. We do electric, we do freight forwarding. So we have, and then similarly in the warehousing and processing side, we have returns, we have now pop-ups, we have long-term storage solutions. We have the ability to do contract manufacturing. So we believe that we are an embedded portfolio of different services, which allows us to create this value proposition more actively. And therefore, there's been a strategic thrust on doing that, and that's the two ends of it. There's a demand side, which I think is an opportunity created by external factors, and then internal move towards leveraging our existing capabilities and adding on to them, both the expanding service lines and, of course, we're building the technology platform, because today we are able to integrate across all these service lines with unified technology platforms which provide end-to-end visibility, which allow us to do integrated heuristics and algorithms. And there's more opportunity to do a lot more in analytics as well to bring supply chains in an integrated fashion alive.
Right.
So that's kind of the broad part. Sorry for a longish answer to that question, but
no, that was helpful. That was helpful, Ram. So just in continuation, so is it fair to assume that it's like a low-hanging fruit, where you go to our warehousing customers and offer the transportation part of it as well? And is it like a low-hanging fruit, and hence we can see that at least instead of a new customer getting added for an integrated solution, existing customer kind of you adding on the transportation side of it, can that happen really quickly? Given that you said they're seeing the benefit of that.
Yeah, so Mukesh, it's not a low-hanging fruit. It's a lot of work, obviously hard work, because you have to integrate all these solutions, right, and actually make them dance and tango together, right? So there are, so there's a lot of capability development on our end, both at a physical layer, at a process layer, as well as a technology layer to put all that together. There's also change from a customer end, because while customers see the intrinsic benefits of this, if you are going to partner end to end, you're also in some ways taking a risk across your entire supply chain.
Right.
And for us, that's a big responsibility, because we are in the contracted performance business. We're not a marketplace where you just come and order a vehicle, and if the vehicle doesn't come, it's your problem, right? Along with these contracts come KPIs and SLAs, and therefore one has to be very deliberate in building the capability to provide the solution. One has also got to be very deliberate in offering that solution to our customers, because not only will it have a big impact on our business, we also have the responsibility of ensuring that there isn't a greater impact on their business. Right? It could triple their business substantially if we don't deliver. So, strategy, and it's not a land grab.
Right.
Working it very deliberately to ensure that we are attacking the right propositions with the right capabilities.
Right. Right. Is it also fair to assume that this integrated solution that you will be offering, would fetch us a higher margin than just transportation plus warehousing? Because you mentioned that there is that lot more dependability, there's a tech involved, etc.
Yeah, I would say that I think the two, three things. I think one is combining. So straight away, I think it's big benefits. It's drives a lot more customer retention because they're providing more integrated portfolio of services, and therefore you're able to retain customers because you're providing a larger value proposition is higher. The second thing is that you obviously will see a blend of warehousing and transportation-based services. So the holy grail of this is the ability to get the higher margin potential of warehousing services with the velocity of transportation. Transportation always has been a higher return on capital employed business, though its margins are a bit lower. So our ability to blend that provides the opportunity to create a more attractive and balanced returns profile. And the third thing which it actually allows us to do, as you know, logistics is an iceberg. The direct cost is actually is equal to the indirect cost, right? Because a lot of inefficiencies exist in the system. Being able to do all of it together allows us to remove inefficiencies from the system. So, simplistically, if you can run the warehouse and do transportation, you manage your ships better. Therefore, you resource the work a lot better. You don't have detentions of vehicles. You put your manpower utilization and productivity can be improved. The technology allows you to plan, the way you run your operations a lot more effectively. So there's a lot of opportunity to eliminate waste, right, which builds your margin profile over a period of time.
Right. Great. Thanks a lot for the detailed answer, Ram. I'll get back to you. Thanks.
Okay.
Thank you. We'll be able to take one last question. We take the last question from the line of Rohil Gandhi from PPFAS Mutual Fund. Please go ahead.
Yeah, hi. Thank you for the opportunity. And hope everyone's well on your end as well. And congratulations on your numbers. Just had a quick question on the EDEL service that you provide. Any metrics that you can provide with respect to that? And since you're adopting a asset-heavy approach in the initial phases like you did with 2x2 logistics, just any sense on how much capex would go in respect to that as well? Any details that you can share with respect to that would be helpful.
Sure. I think first, I shared this in some other platform as well, but we do expect that over the next 2-3 years, we'll build a partner company-owned fleet of around 3,000 vehicles. And we expect that, it'll be, 100 plus 150 crores in terms of revenue. It has the potential to be that. Clearly, and our initial the velocity from our customers, both in e-commerce and other platforms, interest is pretty strong on it. Right. As I said, we have been able to demonstrate in many cases the per package delivery prices of cost to our customers are equivalent to ICE, and therefore we are busting the belief that sustainability comes at a cost. Right. Now, in terms of what it does to our business, in that fleet, a very small percentage of it in the initial phase is actually basically assets we are buying. The fleet overall largely is going to be a partner fleet. Right. So over a period of time, as the fleet builds out, I think you will see that it will take a very normal characteristic. We will remain an asset-light operation, right? In large part, there will be a very small critical mass of company-owned assets, and therefore, I'll also say that our business has been profitable, right? Overall, has been positive contributions from day zero. Right. So we have been able to build, we had some startup costs, but beyond that, in more consistent operations beyond the first few weeks, our business has been hitting our financial targets, and therefore, and consumption does not carry the cyclicality of the auto industry. So our 2x2, so the two differences. One is the assets are not that expensive. Post-FAME subsidy, most of these three-wheelers cost, somewhere in the 3 lakh rupee range. And therefore the asset cost itself is much lesser. And the second thing which is there is that consumption markets don't have the cyclicality that sometimes auto has. And you have seen some of that impact in our 2x2 utilization in the last 18 months, where we obviously have taken a dip in utilization as our auto volumes have come down. Now that is a scenario which doesn't really play out so much because consumption by intrinsically is a far less cyclical trend line. Of course, you can have a COVID kind of situation, but for the large part, it's a lot more secular and in its trend line. Right. So we expect to see far healthier long-term utilization as well. Right. I'm not sure if I answered those questions, but by and large, that's the broad contours from the financial characteristics of the business. Yogesh, I don't know, Yogesh, is there anything I missed, but if you have, feel free to add.
Sure. Sure, we are good for now. Thanks.
And just a follow-up on that also. Going forward, as the battery prices and these technologies get cheaper, like how do you expect that to affect our metrics, considering we continue to adopting asset-light approach in the future? How would that help us manage our costs as well as the pricing strategies for the consumers compared to the ICE vehicles?
No, so I think the two things. I think the two trends which are there. The positive trend is that hydrocarbon-based fuels may not really get cheaper in the long term, right? So I think you've seen that sharper increase in the recent past, but will probably stabilize, but it will still remain. It's not going to go down to $10 a barrel, right? So I think that you can have those black swans, but generally won't happen for the large part. So I think you see a bit of a floor there. I think in terms of the technology change in EVs as well, obviously, we are going to see the battery costs come down, right? But you're also going to see vehicles becoming more native EV, not ICE vehicles being adapted to EV. So both of those will bring down capital intensity in the business, and that's actually a positive trend line, and that's one of the reasons why we feel this initiative is important for us, because in last mile delivery and fleet applications, we think that over a period of time, as EV becomes more cost effective, there is a natural propensity towards using electric, right? Urban logistics is inherently slow speed, requires slow speed, high maneuverability, cost efficient solutions. And electric in many ways supports that intrinsically quite well, right? Its barrier has been some of the capital cost and the belief that, and obviously the applicability of that cost structure to different use cases. So with Eagle, we believe that even we'll be able to prove even with this cost structure that we can actually in many use cases be ICE comparable, not ICE equivalent, but ICE comparable, right? And obviously as capex costs come down, there will be we will continue to see obviously I think a higher upside for electric vehicle based solutions in the cargo and fleet space, especially in last mile delivery where it's it's a sweet spot, less than a ton payload. So it's really a sweet spot where EVs actually are able to do a reasonably good solution within 200 kind of kilometer range. So very optimistic about it overall. Okay.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Well, thank you everyone. I hope we've been able to, and thank you for joining us today. I hope we've been able to answer all your questions satisfactorily. However, should you need any further clarifications, if you'd like to know more about the company or if you have any follow-ups to the questions which you raised today, please feel to contact our team or SG, our investor relations advisors. Like all of you, I hope that the budget will be a great catalyst for the year ahead. And once again, wish you all a very happy New Year and thank you for taking the time to engage with us and thank you for taking the time to join us today on the call. Thank you.
Thank you very much. On behalf of Mahindra Logistics Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.